Imagine this scenario. It is 5 p.m. on a Friday. You are a statutory auditor, and you've just signed your name to the bottom of the financial statements for a massive lending firm.
Right, the classic Friday afternoon sign-off.
Exactly. You've verified their spreadsheets, you checked their math, and you told the regulators and the public that everything is perfectly fine.
And you head home for the weekend?
Yeah. You go home, you relax. But by Monday morning, that same firm defaults on a 170 crore debt payment.
Oh, wow. That's a disaster.
A total disaster. Their credit rating plummets instantly to a D, like default status. Panic ensues. Retail investors are suddenly locked out of their life savings.
Just total chaos in the market.
Right. The entire market is staring at this massive smoking crater where a supposedly healthy financial institution used to be. And everyone turns to look at you, the auditor, and they ask, well, how did you miss this?
It is genuinely the ultimate nightmare scenario in the financial world. And unfortunately, history has shown us that this isn't just some hypothetical situation.
It actually happens.
It does. Because when a non-banking financial company, an NBFC, collapses, it rarely happens in slow motion. I mean, it happens almost overnight.
Why is that? Why is it so fast compared to a regular company?
Well, unlike a traditional manufacturing company that, say, slowly loses market share over years, an NBFC's entire existence relies on this really fragile web of trust.
Just trust and liquidity, right?
Exactly. Trust, liquidity, and perceived stability. So when that trust evaporates, the collapse is catastrophic and immediate.
Which brings us to today. Welcome to the deep dive. We are jumping straight into the deep end of the financial pool today, looking at a stack of highly technical, really high-stakes regulatory frameworks governing the audits of these NBFCs.
And we have a very specific mission for you, the listener, today. We are essentially going to act as your specialized academic and professional tutors.
That's right. Whether you are, say, a CA final student staring down a brutal exam paper or just a financial professional trying to understand the invisible plumbing of our economy, we're building you a mental toolkit.
Because just reading the rules isn't enough. You have to understand the philosophical mindset of the regulator who actually wrote them.
The Reserve Bank of India.
Yes, the RBI. They didn't create these audit requirements just to generate more paperwork for accountants. They created them as a series of pressure valves.
Like emergency bulkheads on a ship, almost.
Exactly. Designed specifically to prevent systemic contagion.
Okay, let's unpack this. If we want to understand how to prevent a collapse, we really need to start at the bedrock.
The absolute foundation.
Right. Before we look at balance sheets or calculate any complex ratios, we have to establish the foundational rules of engagement for an auditor stepping into an NBFC.
And to do that, we have a great scenario. A classic disagreement between two professionals.
There is nothing quite like an internal firm dispute to highlight where the most dangerous misconceptions are. So let's set the scene. We have this audit firm called GYN & Co. They've been appointed as the statutory auditors for Kunthu NBFC Ltd. And inside this firm, two partners are having a pretty heated debate over the audit plan. We have CA Matigian and CA Shretyan.
All right, what are they fighting about?
So Shretyan is taking a very firm stance. He is arguing that evaluating the internal control system and verifying the company's registration with the RBI should absolutely not be part of their statutory audit procedures.
Not part of the statutory audit at all.
Not at all. His logic is that those tasks are strictly the domain of the internal audit team.
That is a fascinating assertion.
Yeah.
And honestly, if you approach this without understanding the specific nature of a statutory audit,
It almost sounds reasonable, right?
it does. You hear the phrase internal control, and it's very easy to just map that directly to internal audit.
Yeah, I'll actually play devil's advocate here for a second because I can kind of see Shretyan's perspective. If a company has a whole department dedicated to internal audits.
Right, their sole job is checking controls.
Exactly. Why should the statutory auditor duplicate that exact same work? Isn't my job as the statutory auditor just to look at the final numbers and make sure they add up?
That is exactly the trap.
Really?
It's an incredibly dangerous trap because as a statutory auditor, you aren't just verifying that the math on the page is correct.
Okay, what am I doing then?
You are expressing an official opinion that those financial statements present a true and fair view of the company's state of affairs.
True and fair.
Yes. How can you possibly know if the final output is true and fair if you have absolutely no idea if the machine generating that output is fundamentally broken?
Oh, I see. So it's like a building inspector coming to check a skyscraper and saying, well, the paint looks nice and the windows are clean, so I'll just sign off.
While ignoring the foundation.
Right. Checking the concrete foundation is the construction manager's job, not mine. That's terrible logic.
Precisely. You cannot divorce the final numbers from the environment in which they were created. Shrutgain's contention is fundamentally entirely incorrect.
So the statutory auditor has to check the controls.
The evaluation of internal controls isn't just some optional preliminary step. It is the absolute compass that dictates the trajectory of the entire statutory audit.
How so?
The regulatory standard requires the auditor to gain an understanding of the accounting system and the related internal controls to determine three vital parameters for their work:
What are the three parameters?
the nature, the timing, and the extent of their audit procedures.
Nature, timing, and extent. Let's translate that into practical action for the listener. If I'm the auditor on the ground, what does that actually mean for my day-to-day work?
Think of it as a risk assessment. Nature means what kind of tests are you going to run?
Like relying on their software versus checking physical documents.
Exactly. Then timing means when will you run these tests? Do you need to be there at the exact moment a transaction happens, or can you look at it retroactively next month?
Okay, and extent.
The extent is your sample size. If the internal controls are ironclad, maybe you only need to test 5% of the transactions.
Because you trust the system.
Right. But if you find that the internal controls are weak or messy, or management just bypasses them whenever they want,
Your risks skyrocket.
exactly, you might have to test 50% or even 100% of the transactions just to be safe.
So by completely ignoring the internal controls, Shrutyan is basically flying blind. He has no idea how much work he actually needs to do.
He's totally blind.
Mm.
But in the context of an NBFC, it's even more critical than a standard corporate audit.
Why is an NBFC different?
The statutory auditor must specifically ascertain whether the NBFC's internal controls are adequate regarding one very specific area, their recovery system.
Their recovery system. Right, because an NBFC's entire business model is just lending money out.
Yes,
So the recovery system is how they make sure that money actually comes back.
exactly. The auditor has to verify if the NBFC has an effective system for the periodical review of advances. Advances being the industry term for the loans they've distributed.
Periodical review. Why is that specific part so crucial?
Because the absence of a rigorous periodical review system could result in the non-detection of sticky advances right at their inception.
Sticky advances, that is such a visceral term.
It really is.
It paints a perfect picture. The money goes out the door, but it doesn't want to come back. It's stuck out there in the economy, trapped with a borrower who either can't or won't pay.
And if those sticky advances go undetected, because the internal controls are weak or non-existent, they just fester.
They just sit on the balance sheet looking like healthy assets.
Right. When in reality, they are rotting. And ultimately, this results in the NBFC accumulating an alarmingly high level of non-performing assets, or NPAs.
So if Shrutyan, as the statutory auditor, ignores the internal controls like he wants to, he misses the sticky advances.
He fails to identify the NPAs.
And the financial statements he ultimately signs off on will just be a complete work of fiction.
A total fabrication.
Wow. Okay, so Shrutyan is dangerously wrong on the internal control issue. But he had a second argument. He also claimed it wasn't his job to verify the company's registration with the RBI.
Right. What's the verdict on that? Is he right there, at least?
He is equally wrong there. Section 45IA of the RBI Act, 1934, lays down absolute mandates.
What does the section actually say?
An NBFC literally cannot commence or carry on the business of a non-banking financial institution without first obtaining a certificate of registration from the RBI.
It's a cost of entry.
Yes, and to get that, they must meet dual conditions. They need the registration itself, and they must maintain a minimum net owned fund.
And the statutory auditor is legally obligated to verify that these conditions are met.
Absolutely legally obligated.
You know, what's fascinating here is the role the regulator is forcing the auditor to play. The statutory auditor isn't just an independent accountant checking spreadsheets for the shareholders anymore.
No, they're much more than that.
The RBI is essentially deputizing the auditor. You're like a frontline compliance enforcer for the central bank.
That is a profound way to look at it, and it's very true. The RBI obviously cannot physically place a regulator inside every single NBFC every single day. They don't have the manpower.
So they use the statutory auditor as their eyes and ears to ensure the gates are being kept.
Okay, so if Shretyen's minimalist, hands-off approach is a recipe for disaster, what is the right way? What is the actual toolkit a statutory auditor needs to carry when they walk into an NBFC?
Our source material outlines 5 broad mandatory areas that must form the core of any NBFC audit procedure.
And since our mission is to act as your tutors and make this unforgettable for you, the listener, we are going to give you a mnemonic.
Structure is vital for these exams and for real-world practice.
But we aren't just going to give you a silly word to memorize. We are going to connect this to the mindset of the auditor.
If you miss even one of these 5 pillars, the entire audit is compromised.
Exactly. When you step into an NBFC as an auditor, you aren't just casually looking around. You are on the clock. You are actively hunting for risk. So I want you to picture yourself in a race.
A very high-stakes race.
But specifically, you are in a race for the profit. RACEP. Let's break down exactly what each of those letters means, and more importantly, why the regulator demands you check them.
Let us begin with R.
R stands for registration with the RBI. This is the exact point Shretyen completely failed on.
The auditor must check Section 45IA of the RBI Act.
Right. You need to physically or digitally see that certificate of registration. Or, if they are a brand new entity, you need to see the application form.
And it isn't just glancing at a piece of paper. Verifying registration means verifying those dual conditions we discussed.
The RBI registration itself and the continuous maintenance of the minimum net owned funds.
Exactly. You are also checking their foundational regulatory health. Are they making their mandatory investments in prescribed liquid assets?
Are they consistently and accurately filing their quarterly returns with the RBI?
Yes. This step is all about establishing their legal right to even exist as a business.
Okay, so they legally exist. We check they are. Now we move to A. A stands for ascertaining the business. Now, I might actually push back here. Oh.
If the sign on the door literally says, lending company, haven't I ascertained the business? Why is this a formal, separate step?
Well, because what the sign on the door says and what the legal framework of the company actually permits can be two very different things.
Okay.
You cannot effectively audit a business if you don't understand its structural DNA.
So what are we looking at?
The very first step under A is scanning through the Memorandum and Articles of Association, the MOA and AOA.
The founding documents.
Right. This fundamentally acquaints the auditor with the exact type of business the company is legally authorized to engage in.
And I imagine this dictates what rules apply to them down the line.
Crucially, yes. Based on this business profile, the auditor determines what specific limits on public deposits the NBFC must comply with.
Under the NBFC public deposit directions, right?
Exactly. An investment company has very different risk profiles and limits compared to, say, a microfinance institution. You have to ascertain the business to know which rulebook you even need to open. That makes perfect sense. So we have R for registration, A for ascertaining the business, now for C.
C stands for classification.
And this is deeply tied to the previous point, isn't it?
It is. The regulatory landscape for NBFCs is heavily segmented. The auditor must ensure the company is properly classified as per the various RBI regulations.
And interestingly, if the RBI hasn't explicitly classified them yet, the auditor cannot just sit around and wait.
No, they have to figure it out themselves based on the application form, the MOA, and the actual financial results. You have to put them in the correct regulatory bucket yourself.
So we have R, A, C. Now we hit E. E stands for Evaluation of Internal Controls. This brings us right back to our debate with Shretyen.
This is where you test the machine.
You check the accounting systems, you determine the nature, timing, and extent of your upcoming audit procedures.
And most critically for an NBFC, this is where you rigorously review the effectiveness of that recovery system we talked about.
You are looking for the mechanisms they have in place to periodically review advances, specifically to prevent those sticky advances from turning into massive non-performing assets.
It's essentially the diagnostic check of the company's immune system. If the E shows weak controls, the auditor knows the balance sheet is highly vulnerable to infection.
So we've run the RA, C, E, and finally we reach the P. The race for the PP stands for Prudential Norms Directions.
This is where the heavy lifting happens.
This is the massive, granular checklist of financial health.
The prudential norms are the core quantitative constraints placed on the NBFC. The auditor must check compliance with norms encompassing income recognition.
Meaning, when are they legally allowed to claim they actually made money?
Exactly. Asset classification. How are they grading the quality of their loans? provisioning for bad and doubtful debts.
How much money are they setting aside for the loans that probably won't come back?
Right. And of course, capital adequacy norms, which we will dive into deeply later in this session.
It also includes strict prohibitions, right? Like making sure the NBFC isn't doing something crazy like granting loans against its own shares.
Yes, or making investments or granting loans when they have failed to repay their public deposits. The prudential norms are the absolute boundaries of acceptable risk-taking.
So let's lock this in for the listener. R, registration. A, ascertaining the business. C, classification. E, evaluation of internal controls. P, prudential norms directions, RACEP.
It's not just a random list. It is a logical, chronological workflow.
Yeah, you check if they exist legally, you figure out what they do, you classify them, you check how strong their internal systems are, and then you measure them against the strict prudential rules.
It's a brilliantly interconnected framework. You cannot evaluate the prudential norms, the P, if you haven't ascertained the business, the A too, to know which specific norms apply to their classification.
So Shutkian was trying to take a shortcut by skipping E and R.
But in the world of shadow banking, shortcuts don't save time. They lead to systemic collapse.
Okay, we've laid the foundation, we have our RACEP toolkit, and we know how to look for cracks in the foundation during a normal audit. But we just established that part of ascertaining the business includes checking public deposit limits.
Yes, that's a critical component.
And that leads us to a much darker, much more stressful scenario. We've talked about routine, sunny day compliance checks, but what happens when the auditor finds those cracks, the numbers turn red, and the market starts to panic?
The transition from a stable environment to a crisis environment in the financial sector is notoriously unforgiving.
It's not a slow decline.
No, it rarely happens gradually. It is usually a sudden, violent reaction driven by a sudden loss of liquidity and a complete evaporation of market confidence.
Which brings us perfectly to our second scenario. Let me set the stage for you. We are looking at a company called Kunthu Ltd.
Okay.
They are an NBFC focused specifically on housing finance, and they are not some small regional player. They have a massive footprint with branches operating all across India.
A major institution.
Very major. And on their books, they have outstanding non-convertible debentures worth 170 crore rupees.
That is a highly significant amount of debt. It represents a major obligation to their creditors.
And here is where the dominoes start to fall. Kunthu Ltd. recently missed an interest payment. It was a 17 crore payment on those debts, and they just flat out missed it.
Why did they miss it?
The official reason is inadequate liquidity. They simply did not have the cash on hand when the bill came due. Now, the market hates nothing more than missed payments.
They despise it.
Consequently, the credit rating agencies stepped in. Over the course of just 2 months, they absolutely slashed Kunthu Ltd.'s credit rating. They dropped it from a relatively stable A4 rating all the way down to a D.
A downgrade to D is the financial equivalent of flatlining.
It's that bad.
Oh, D implies that the company is currently in default or is expected to be in default very imminently. The market, through the rating agencies, is officially stating that they do not believe this entity has the capacity to meet its financial obligations.
Now, enter CA Sheetal. She is the statutory auditor conducting the audit for Kunthu Ltd. right as this downgrade is happening.
Talk about bad timing.
Exactly. So I have to ask, what does this actually mean on the ground? If I'm CA Sheetal and I see this massive downgrade to D, I'm looking at a sinking ship.
Yes.
How does this specific downgrade legally impact Kunthu's ability to hold on to the public's money? It makes me think of a restaurant that just failed a massive health inspection and got a giant red F grade pasted on their front door by the city.
That's a great analogy.
Surely they can't just keep taking reservations, seating people, and serving food as if nothing happened, right?
They absolutely cannot operate as usual. When an NBFC takes public deposits, they are playing with the savings of everyday citizens.
Right, retail money.
The RBI has engineered very strict, non-negotiable regulations regarding the mobilization of public deposits to prevent a failing, desperate institution from taking down retail depositors with it.
How does that mechanism actually work? Because obviously a failing company wants more cash to survive. They want to bring more money in.
And that is exactly the instinct the RBI is trying to counter. First, we have to understand that for an NBFC, the ceiling on the quantum of public deposits they are legally allowed to hold is directly, inextricably linked to their credit rating.
And this rating must come from an approved credit rating agency.
Right.
So the RBI doesn't rate them themselves.
No. The central bank essentially outsources the real-time granular risk assessment to these specialized rating agencies.
Let's see.
The rules are dynamic. If a rating goes up, the NBFC might be allowed to accept more deposits. But if the rating goes down, or in this catastrophic case, falls off a cliff, the NBFC doesn't have a choice.
They have to shrink.
They must adjust their public deposits downwards to align with the revised lower credit rating within a specific time frame. And, crucially, they must inform the RBI about this change in writing immediately.
It's like an automatic stabilizer. You get downgraded, your capacity to take public money instantly shrinks. It forces the company to shrink its risk footprint. But Kunthu Ltd didn't just get a minor downgrade from an A to a B. They dropped below the minimum specified investment grade. They hit D.
Right. And when an event like that occurs, a downgrading below the minimum specified investment grade for a non-banking financial company, specifically an investment and credit company, or a factor, it triggers a very strict, legally mandated protocol.
To do what?
To regularize the excess deposits. The auditor, CA Sheetal, isn't there to save the company. Her job is to verify that the management immediately implemented 4 exact mandatory steps to quarantine the risk.
And as your tutors, we aren't going to let you just passively listen to a dry list of 4 regulatory steps. We want you to feel the urgency of this moment.
It is a true crisis scenario.
When an NBFC's rating drops to default, the alarms are blaring.
Right.
I want you to literally picture red flashing lights and a loud siren going off in the NBFC's headquarters.
As a siren.
Because our mnemonic for CA Sheetal's mandatory checklist is exactly that. SRRN. Think of a siren sounding the alarm during a crisis. SRRN. Let's look at exactly what this crisis protocol demands.
The first step is the most urgent, and it is absolute. S stands for stop.
Stop what?
With immediate effect, the NBFC must stop accepting fresh public deposits. Furthermore, they must stop renewing existing deposits. The influx of new public money is completely and utterly severed the moment that downgrade hits.
You fail the health inspection, you lock the front door, nobody new comes in to eat. That's the S. Stop. It cuts off the oxygen supply to the fire.
Precisely.
Next up in our siren is R. The first R stands for runoff. The regulation states that all existing deposits shall run off to maturity.
Now, I want to pause here because runoff is a critical financial concept that is very often misunderstood.
Yeah, let me push back on this, actually. If the company is collapsing, why let the deposits run off? Why not just force the NBFC to immediately refund everyone's money right that second? Freeze the accounts and give the money back.
Because if you force an immediate total refund, you will cause the very collapse you're trying to prevent.
Well,
think about it. If an NBFC is forced to liquidate all its assets overnight to pay back all depositors simultaneously, it has to sell those assets at a massive discount, a fire sale.
oh, right, because they're desperate.
Exactly. They will run out of cash immediately, and most depositors will end up getting nothing. Runoff is a mechanism for an orderly unwinding.
So what does it actually look like in practice?
It means the NBFC cannot unilaterally cancel and repay the deposits prematurely unless specific hardship conditions allow. Rather, they must let the existing contracts play out.
So if my deposit matures in 6 months, I have to wait 6 months.
Yes. As the deposits naturally reach their scheduled maturity dates over the coming months or years, the money exits the NBFC's ecosystem and returns to the depositor.
I get it. The balance sheet is slowly, methodically deflated rather than popped with a needle.
That's a perfect way to describe it.
That is fascinating. So it's about preventing a sudden shock to the system. Stop new money and let the old money slowly run off. Now for the second R in our SRN mnemonic, report.
Yes, report.
The NBFC must report their position within 15 working days to the concerned regional office of the RBI where the NBFC is registered.
This 15 working day window is a critical reporting threshold. It forces absolute transparency during a crisis.
So the RBI knows exactly how bad the fire is.
Exactly. The regulator is immediately brought into the loop regarding exactly how much excess deposit exposure currently exists. This allows the RBI to actively monitor the runoff process.
And it ensures that the NBFC management isn't trying to hide the severity of their liquidity crisis from the central bank.
Right. There's no sweeping it under the rug.
Well, so we have stop, runoff report. Finally, the N in our siren. N stands for no renewal. Specifically, the regulation dictates that no matured public deposit shall be renewed without the express and voluntary consent of the depositor.
This point often causes confusion among students and professionals, so let's parse it very carefully.
Yeah, because earlier we said stop renewing existing deposits under the stop phase. So why have no renewal as a completely separate step here?
Excellent question. The no renewal clause adds a layer of absolute documented depositor protection once the deposit actually reaches its maturity date during the runoff phase.
Oh, because what if a depositor actually wants to keep their money there? Like
Yeah.
maybe the NBFC, in a desperate bid for cash, offers an astronomical 15% interest rate, and some investor thinks it's worth the gamble.
Exactly. Greed can make people take massive risks. If a depositor somehow still wants to keep their money in a D-rated defaulting institution, the NBFC cannot simply rely on an old auto-renewal clause buried in the original contract.
They can't just silently roll it over.
No, they need explicit, affirmative, voluntary consent in the present moment, proving that the depositor fully understands the massive risk they are undertaking.
It's basically making the depositor sign a legal waiver that says, I have been informed that the building is currently on fire, but I am voluntarily choosing to leave my suitcase full of cash in the lobby anyway.
Precisely. That is exactly what it is. The SRN protocol stop, runoff report, no renewal is a brilliantly designed regulatory quarantine. It isolates the infection.
If we step back and look at the philosophy of this, it really shows how systemic risk is managed at a macro level.
The regulator doesn't just sit around and wait for a judge to declare total irreversible bankruptcy.
The moment the rating drops below investment grade, the Siren Protocol acts as an immediate quarantine to protect new depositors from being sucked into a liquidity black hole.
Right.
C.A. Sheetal's job is incredibly stressful, but it's clearly defined. She isn't there to give business advice. She's there to verify that the quarantine doors were shut and locked exactly when the regulations demanded it.
It is a heavy responsibility.
Yeah.
You are auditing a company in the middle of a financial heart attack, making sure the paramedics followed the exact triage protocol.
Okay, we've navigated the foundational internal controls, and we've survived the SRN protocol of a crisis downgrade.
Now we need to look at normal reporting.
Exactly. Let's look at the day-to-day. How do these entities actually report their financial health to the public when they aren't in crisis? How do you measure an NBFC? It turns out, NBFCs have a completely different reporting language than regular companies.
They speak a completely different dialect of accounting, and this is entirely necessary given the fundamental nature of their business model.
Which brings us to what we'll call the disclosure dilemma. We have a new scenario. Meet Suhana.
Okay, Suhana.
Suhana is a diligent CA final student, and she is working as part of the engagement team conducting the statutory audit of CMM Finance Limited. Now, it's important to note that CMM is a listed NBFC.
Listed is an important distinction.
Yes. So Suhana is going through her audit program, reviewing the steps prepared by the engagement partner, and she notices it contains very specific instructions for verifying disclosures based on Schedule 3 of the Companies Act 2013.
For context for the listener, Schedule 3 is essentially the master structural template that dictates exactly how the balance sheet and the statement of profit and loss must be presented by companies in India.
It's the formatting rulebook.
Yes, exactly.
Right. So Suhana looks at her instructions, and she has two specific rules she is told to follow. Rule 1. She needs to verify the disclosure of any single item of income or expenditure which exceeds 1% of revenue from operations, or 10 lakhs, whichever is higher.
Okay.
And Rule 2. She needs to verify the disclosure of specific performance ratios, namely return on capital employed, ROCE, return on equity, ROE, and the net profit ratio.
And simply hearing those instructions read aloud should immediately set off alarm bells for anyone who understands how a financial institution functions.
Here's where it gets really interesting, because Suhana's instructions feel completely wrong intuitively. Let's think about this logically. Let me give you an analogy.
Please do.
Using these specific metrics to measure an NBFC feels exactly like trying to use a medical thermometer to measure the air pressure in your car tires. It's an instrument meant for a completely different environment.
How so?
Yeah.
Unpack the thermometer analogy for us.
Well, think about a standard retail store that sells shirts. They have clear revenue from operations. They sell a shirt. They make money. Measuring an expense against that revenue makes sense.
Right.
And looking at their return on equity makes sense. It tells you how efficiently they are turning shareholder investment into profit from selling shirts. But an NBFC doesn't sell shirts.
No, they don't.
Their entire operation is just moving money around, borrowing at one rate and lending at a higher rate. It's just interest flows, risk premiums, and duration matching.
Exactly.
Looking at their return on equity just tells you if they are making a profit today. It doesn't tell you if they are taking on so much risk that they are about to go bankrupt tomorrow. Is Suhana using the wrong rule book?
She absolutely is, and your intuition is spot on. Suhana's instructions, as drafted by the engagement partner, pertain entirely to Division 2 of Schedule 3 of the Companies Act. 2013.
Division.
Yes. Division 2 applies to regular non-financial companies, your shirt retailers, your manufacturers, your IT service providers. However, CMM Finance Limited is a listed NBFC. Therefore, it is strictly governed by a completely different section, Division 3 of Schedule 3.
Division 3.
The engagement partner on this audit has made a massive, foundational error in drafting the audit program, and Suhana's instructions must be revised entirely.
So if Division 2 is the thermometer, what does the tire pressure gauge of Division 3 actually look like? What are the correct tailored disclosure rules for an NBFC?
The differences are highly specific and tailored to the unique financial risk profile of lending institutions. Let's take Suhana's first instruction. Instead of looking at an item exceeding 1% of revenue from operations or 10 lakhs, Division 3 simplifies and focuses the metric.
What does it focus on?
For a listed NBFC, the disclosure requirement is simply any item of other income or other expenditure which exceeds 1% of total income, period.
Total income, not revenue from operations. That makes so much more sense because an NBFC's operations are so fluid. Interest income, dividend income, fee income, it's all just part of the total income pool.
Exactly. It removes the ambiguity of defining what constitutes core operations for an entity that simply manages capital. But the much more profound philosophical difference lies in the ratios.
Right. Suhana was told to check ROCE, ROE, and net profit ratios.
And under Division 3, those are irrelevant for the core statutory disclosure requirements. Instead, the NBFC must disclose entirely different ratios that are focused squarely on risk management and capital buffers.
And since we are your tutors, we want you to internalize this philosophical shift. The insight here isn't just memorizing a new acronym, it's understanding why the regulator changed the rule.
It's a fundamental shift in perspective.
If you are auditing a regular company, you judge them by their engine. How fast are they going? How much profit are they generating? That's your ROE. But if you are auditing an NBFC, you don't judge them by their engine, you judge them by their armor.
That is an excellent way to frame it. Survivability versus profitability.
Exactly. So how do we measure the armor? We have a visual mnemonic for you. If you are auditing an NBFC, you aren't looking at the ROE boat floating on the water. You are walking into the garage to inspect the heavy machinery.
The garage.
And what's parked in the garage? It's all about the SARs.
Pronounced like automobiles. Cars.
Right. It's all about the SARs. If you get a question about Division 3 disclosures for an NBFC, I want you to immediately picture 3 heavily armored cars parked in a garage. Because under Division 3, the 3 required ratios that must be disclosed are...
Let me list them.
Go ahead.
First, the overall CARRs, which stands for Capital to Risk-Weighted Assets Ratio. Second, the Tier 1 CARR. And third, the Tier 2 CARR. That's it. It's all about the CARR.
Tier RR, Tier 2 CARR.
To expand on why this philosophical shift is so critical, an NBFC could boast an incredibly high return on equity right up until the very hour it completely collapses.
Wow, really?
Oh, absolutely. In fact, high ROE in a financial institution can often be a warning sign. It might indicate they are massively overleveraged, taking on huge amounts of high-risk debt with very little of their own equity backing it up just to juice their returns.
Right. They are driving a car with a massive engine, but absolutely no seatbelts or airbags. One crash, and it's over.
Exactly. The RBI, the stakeholders, and the depositors don't just want to know how much money the NBFC is making during a boom market.
They want to know if it can survive a bust.
They demand to know if the NBFC has enough of its own capital to absorb massive, unexpected losses during a crash without defaulting on its obligations. That is exactly why SHIAR, the Capital to Risk-Weighted Assets Ratio, is the mandatory disclosure.
It forces the NBFC to explicitly mathematically state how thick their capital armor is compared to the specific risks they carry on their balance sheet.
It's transparency of risk, not just transparency of profit.
So Division 3 of Schedule 3 throws out the profitability thermometer and brings in the CRs to measure the armor. I love that, but it begs a massive practical question.
Which is?
We keep saying, it's all about the CRs. But how do you actually calculate a CR? How do you take a massive, sprawling financial institution with billions of dollars moving in 1,000 different directions and boil its entire survivability down to a single percentage point?
It requires a very rigorous, highly structured mathematical framework. You have to categorize the company's capital by its absolute quality, and you have to weigh their assets by their inherent riskiness.
Well, it's time to put on our math hats. We're entering our final segment. This is the Capital Adequacy Calculation Bootcamp. We are going to build the armor ourselves.
This is where regulatory theory meets harsh mathematical reality.
We have our final scenario. We are looking at an institution called Quora Capital Ltd. They are an NBFC classified under the scale-based regulation framework. The regulator has issued a strict mandate. They must maintain a minimum capital ratio of 15% of their aggregate risk-weighted assets, or RWA.
To be precise, it is 15% of their aggregate risk-weighted assets on the balance sheet, as well as their risk-adjusted value of off-balance sheet items. 15% is the absolute floor. If they dip below that threshold, regulatory intervention begins.
Now, Quora Capital Ltd. is a heavy hitter. Their risk-weighted assets total an enormous 8,000 crore rupees.
8,000 crore.
We have been provided with a laundry list of financial data extracted from their balance sheet, and our job is straightforward but complex. Calculate their Tier 1 capital, calculate their Tier 2 capital, and finally determine if they actually meet that 15% survival rule.
Before we simply start crunching the numbers, we need to conceptually define what Tier 1 and Tier 2 capital actually represent in the real world. Otherwise, this is just meaningless arithmetic.
Let me give you an analogy to anchor this concept for the listener. Think of your own personal finances when you are facing a sudden, massive emergency like your roof caves in and you need cash immediately. Think of Tier 1 capital as the cash sitting directly in your physical wallet or your primary checking account. It is pure, it is universally reliable, it is instantly available to cover a loss, and most importantly, it is completely yours. It has no strings attached, no maturity dates, and no conditions.
In regulatory terms, we call this the highest quality capital, or going concern capital. It is the core equity that allows a bank to absorb losses while still continuing to operate normally.
Exactly. Now, think of Tier 2 capital as your emergency stash up in the attic. Maybe you have a rare gold coin collection, or maybe you have some specialized savings bonds that take time to mature.
Something with value, but not instantly accessible.
Right. Does it have real value? Absolutely. Can it help you in an emergency? Yes. But it is fundamentally a step down in quality from the cash in your wallet. It might take a week to liquidate the gold coins, you might get a bad price for them depending on the market, or the bonds might have specific penalty conditions attached to them if you cash them early. It's valuable, but it's flawed.
Tier 2 is often referred to as gone concern capital. It is secondary armor that usually only fully comes into play to protect senior depositors when the institution is already failing or being wound down. The regulator wants to know exactly how much of both you have, but they treat them very differently.
That distinction is crucial. Let's look at the source data for Quora Capital Ltd. And walk through the exact math to determine the size of their wallet Tier 1 and their attic stash Tier 2. We start with Step 1, calculating Tier 1 capital.
The core building block of Tier 1 is what is legally termed the owned fund. For Quora, the owned fund is given in our data as 1,000 crore.
That is our starting positive number, 1,000 crore in the wallet, but we have to make adjustments, right?
Yes. The very next item on our list is investment in shares of other NBFCs and in group companies. This item sits at 150 crore, and the note specifically says it exceeds 10% of the owned fund.
Now, I might look at that and say, hey, an investment is an asset. It has value. We should add that to our capital. But my gut says the regulator disagrees.
Your gut is correct. We must subtract it.
Why?
Think back to our discussion on systemic risk and contagion. If Quora Capital takes its own core capital and invests it into its own subsidiary group entities, that capital isn't actually acting as an independent external buffer against macroeconomic shocks.
It is just circulating within the same incestuous corporate family.
Exactly. If the broader market crashes and the group entity goes down, that capital vanishes precisely when Quora needs it most. Therefore, strict regulatory guidelines mandate that we must deduct these group investments to find the true independent capital buffer. So we subtract the entire 150 crore.
Got it. 1,000 minus 150. We are currently at 850. Next item. Perpetual debt instruments issued by Quora Finance Ltd. This is standing at 120 crore.
Perpetual debt is a fascinating financial instrument. It is technically debt, but it acts very much like equity because it has no maturity date.
So they just pay interest forever.
Exactly. The issuer never actually has to pay back the principal. Because it doesn't have a looming repayment deadline, it has a very high capacity to absorb losses without triggering a default. Therefore, the RBI deems it eligible for Tier 1 capital.
Is there a limit on it, though? It's still debt, after all.
Yes. The source material notes a specific regulatory limit. These perpetual instruments are limited to 15% of the previous year's Tier 1 capital. However, for the sake of this specific calculation, the source text assumes the entire 120 crore qualifies under the limit, so we add it to our Tier 1 bucket.
So our wallet math is actually quite straightforward. Owned fund of 1,000, subtract the Ancestors Group investments of 150, add the eligible perpetual debt of 120. 1,000 minus 150 plus 120 equals 970 crore. That is our total Tier 1 capital. The pure, reliable cash in the wallet is exactly 970 crore.
Precisely. Now we must move to step 2, calculating Tier 2 capital, the attic stash. This list is much messier, full of complex financial instruments that require specific, sometimes brutal regulatory adjustments.
And because it's messy, it's the perfect place for a professional exam or a real-world audit to trip you up. But we're going to give you a tool to master it. When you are looking at a messy balance sheet trying to figure out what qualifies as Tier 2 capital, I want you to remember this phrase. PRGHS penguins. Really go hunting squid. PRGHS.
I will admit, while unconventional, it is highly memorable.
It paints a vivid picture. Let's map the penguins hunting squid directly to the Tier 2 balance sheet items provided in the core capital scenario. We'll explain the mechanics of each one as we go.
Yeah.
First up, the penguins. P stands for preference shares.
Specifically, this refers to preference shares that are not compulsorily convertible into equity. They act like a hybrid of debt and equity. Our data shows Quora has 80 crore of these. We take the full 80.
Okay, 80 goes into the attic. The next item is the R, in really. R stands for revaluation reserves. Our raw data shows 200 crore, but here is where you must apply a strict regulatory haircut.
Yes, a very strict one.
Wait, I need to push back here. What exactly is a revaluation reserve? And if it says 200 crore on the balance sheet, why are we giving it a haircut? That feels like stealing equity.
Let's break it down. Imagine Quora Capital owns a massive headquarters building in Mumbai that they bought 20 years ago.
Okay.
On their historical accounting books, due to standard depreciation, that building might be recorded as being worth very little.
Okay.
But if they revalue that building to current modern market prices, they suddenly generate a massive reserve of value on their balance sheet. That is your revaluation reserve.
Okay, so they just realized they have 200 crore of extra wealth. That sounds great.
It sounds great on paper, but what is the fundamental problem with real estate in a crisis?
Yeah.
It is highly illiquid. That 200 crore value is just theoretical until they actually sell the building.
And selling a building takes time.
Exactly. If Quora Capital is facing a liquidity crisis and needs cash today to pay off depositors, they cannot sell a skyscraper by Tuesday. Furthermore, if the whole economy is crashing, the real estate market is probably crashing too.
So they might not even get the 200 crore.
Right. So the regulator looks at that 200 crore and says, we acknowledge this value exists, but we do not fully trust it in a hurricane. Therefore, they enforce extreme pessimism. You must apply a massive 55% discount to revaluation reserves when calculating Tier 2 capital.
A 55% discount. That is a brutal haircut. They're basically saying we assume your real estate is only worth 35 cents on the dollar during a panic.
It is conservative by design. So let's look at the math from the source text. We take the 200 crore and we apply the 55% discount factor. Now, I want to clarify the phrasing here because it can be tricky. The source solution verbatim states, revaluation reserves at 55% discount equals 200 crore times 55% equals 110 crore.
Right, so let's be mathematically precise. 55% of 200 is 110. Does that mean the discount is 110, leaving an eligible amount of 90? Or does it mean the eligible amount we use is 110?
The phrasing in the source material implies the calculation multiplying by 55% results in the final eligible amount of 110 crore being added to the tally. In a real-world scenario, you would confirm the exact regulatory formula, but as impartial guides to the specific source text, we must adhere strictly to the math provided. The amount we add to our Tier 2 bucket for revaluation reserves is 110 crore.
Okay, we will stick to the source math. We have Penguin's preference shares at 80 and really revaluation reserves at 110. Next is GO. G stands for General Provisions and Loss Reserves.
These are funds set aside to cover potential future loan losses that haven't been specifically identified yet.
The actual amount on Quora's books is 50 crore. Do we just take the 50 and throw it in the attic?
We can take the 50, but only after we check the ceiling.
Is it a ceiling?
The RBI puts a strict cap on how much general provisioning can count towards your capital. Why? Because if you have massive general provisions, it might indicate you have a massive unrecognized risk problem in your loan portfolio. You shouldn't be rewarded with higher capital ratios just because you expect to lose a lot of money. The ceiling is strictly limited to 1.25% of the total risk-weighted assets.
Our RWO is massive. 8,000 crore. Let's do the math on the ceiling. 1.25% of 8,000 crore, that comes out to 100 crore.
Exactly. The absolute maximum they could claim under this category is 100. Since their actual general provisions are only 50 crore, which is well below that 100 ceiling, we can safely include the entire 50 crore in our tier tally.
Excellent. Penguins really go. Now for hunting. H stands for hybrid debt capital instruments. The data says 90 crore. We add it straight in. And finally, SWID. S stands for subordinated debt.
Subordinated debt is a classic Tier 2 instrument. Subordinated means that in the event of bankruptcy and liquidation, the holders of this debt get paid after all the regular depositors and senior creditors. Because they take the hit first, this debt acts as a buffer protecting the senior stakeholders.
The data shows 140 crore for subordinated debt. We add that straight in as well. Are we done with the attic?
There is one final note to check regarding perpetual debt. Remember the perpetual debt from our Tier 1 calculation?
Yeah, the 120 crore.
We said there was a regulatory limit to how much could be claimed there. Any excess perpetual debt that exceeded the Tier 1 limit wouldn't just vanish, it would cascade down and be counted here in Tier 2. However, in our Step 1, the entire 120 crore was fully absorbed within the Tier 1 limits. Therefore, the excess spillover is 0. We add nothing extra here.
Okay, let's total up our attic stash. Let's sum up our Tier 2 capital. We have preference shares at 80, plus the heavily discounted revaluation reserves at 110, plus general provisions at 50, plus hybrid debt at 90, plus subordinated debt at 140, plus our perpetual debt spillover of 0. 80 plus 110 plus 50 plus 90 plus 140 plus 0. That gives us a grand total for Tier 2 capital of 470 crore.
We now have our two fundamental numbers. Tier 1, the wallet, is 970. Tier 2, the attic stash, is 470. But before we combine them to find the total armor, we must verify the golden rule of Tier 2 capital.
There is always a golden rule in finance.
There is, and it's non-negotiable. The regulation states that an institution's Tier 2 capital cannot, under any circumstances, exceed its Tier 1 capital. The attic stash cannot be larger than the pure cash in the wallet.
Let me guess the philosophy here. If your Tier 2 is larger than your Tier 1, it means the overall quality of your capital buffer is too degraded. You are relying way too much on complex, illiquid instruments, discounted real estate, and subordinated debt, rather than pure, reliable equity.
That is exactly the rationale.
Yeah.
The RBI wants high-quality survival capital. So we check, is our Tier 2 of 470 greater than our Tier 1 of 970? No. It is safely below the limit. Therefore, the entire 470 crore of Tier 2 capital is fully eligible.
Which brings us to Step 3 and 4, the final calculation, the moment of truth to see if core capital survives the audit. We need the total capital. Total capital equals Tier 1 plus Tier 2, 970 plus 470. That gives us 1,440 crore in total capital. That is the thickness of our armor. Now we measure it against the risk.
Right, the capital adequacy ratio.
The formula for the capital adequacy ratio, the CIR, is total capital divided by risk-weighted assets multiplied by 100 to get the percentage. So 1,440 divided by our massive 8,000 RWA multiplied by 100, the raw math gives us 17.5%.
Now here we encounter a very interesting mathematical quirk in our provided source material. And as impartial guides through this text, we must point it out, as it highlights the sometimes messy reality of regulatory documents.
Right. If you do the raw math right now on your phone calculator, 1,440 divided by 8,000 times 100, it will definitively say 17.5%. The source text explicitly shows this calculation in Step 3, literally stating equals 17.5%. However, in the very next section, Step 4, the conclusion, the source text explicitly states actual capital adequacy ratio equals 18%.
It is an inconsistency within the provided solution text itself. In the real world of auditing, this is exactly the kind of discrepancy you might spend an afternoon chasing down. Is it possible the 18% was simply rounded up for ease of reporting? Yes. Is it possible it reflects an assumed variable or a secondary risk adjustment not explicitly detailed in the raw math steps provided? Also. Yes. However, our job today isn't to rewrite the source material or invent data to fix a typo, but to understand its implications.
Exactly. We are looking at the gray areas of regulation. Whether we look at the raw mathematical output of 17.5% or we look at the explicitly stated conclusion of 18%, we have to ask the final, ultimate question for CA Sheetal or any auditor: does Core Capital Ltd survive?
The regulatory minimum under the scale-based regulation framework is definitively 15%. Both 17.5% and 18% are comfortably higher than that 15% minimum requirement. Therefore, the conclusion remains solid regardless of the mathematical quirk. Core Capital Ltd. Safely meets the regulatory capital adequacy norms. Their armor is thick enough to withstand the risks they carry on their books.
They passed the test, and so do you. Let's take a deep breath and summarize the incredible academic and professional journey we just took. We didn't just read rules, we mapped the invisible plumbing of the shadow banking system. We built a toolkit.
We started by dismantling C.A. Schruttgen's dangerous misconception. We learned that statutory auditors absolutely must evaluate internal controls because checking the recovery system is the only way to find those hidden sticky advances before they destroy the balance sheet.
And we gave you your primary tool, the RACEP mnemonic, for the mandatory audit areas: registration, ascertaining the business, classification, evaluation of internal controls, and prudential norms.
Then we moved from stability to crisis. We watched Kunthu Ltd. Suffer a catastrophic credit downgrade to D. We explored how the RBI dynamically links public deposits to credit ratings to manage systemic risk and prevent contagion.
And we learned the quarantine protocol using the SRRN mnemonic. When the crisis hits, the siren goes off. Stop new deposits, let the old ones run off methodically, report to the RBI within 15 days, and demand explicit consent for no renewal.
We then solved Suhana's disclosure dilemma, discovering the philosophical shift of Division 3 of Schedule 3. It judges financial institutions on their survivability armor, not just their operational engine.
Remember the garage. It's all about the cars. 4, Tier 1, poor, and Tier 2, well air.
Finally, we crunched the rigorous numbers for Core Capital Ltd. We separated pure Tier 1 wallet capital from the Tier 2 attic stash capital.
Using our favorite mnemonic of the day to decipher the messy balance sheet, PRGHS penguins really go hunting squid. Preference shares, revaluation reserves with that brutal, pessimistic 55% discount. General provisions under the ceiling, hybrid debt, and subordinated debt. We confirmed the golden rule that the attic can't be bigger than the wallet, and we proved they had enough armor to beat the 15% minimum.
It is a dense, highly technical landscape, but it is entirely logical once you understand the core objective of the regulator: preventing a sudden collapse in market confidence. Which brings me to a final thought I'd like to leave you with.
Please, go ahead.
This raises an incredibly important question. We have spent this time seeing how meticulously these regulations are structured, from the exact 55% discounts on real estate revaluations to the strict 15 working day reporting windows during a liquidity crisis. The math is rigorous. The protocols are airtight on paper. But regulations, no matter how perfectly written, are only ever as good as the human auditors actively enforcing them in the field.
That's very true.
If an auditor like Strutgen from our very first segment is out there today, genuinely believing that internal controls and sticky advances aren't his problem, how much invisible risk is currently sitting in the shadow banking sector right now, just waiting for a downgrade to trigger the collapse?
That is a chilling thought. The dam is only ever as strong as the inspector looking for the cracks. I want to encourage you to take this toolkit, review your own notes, and actively apply the RACEP, the Siren Quarantine, the CRRs, and the Penguins mnemonic to your study material or your daily work. Approach your next financial deep dive not just as a student trying to memorize a list of facts, but with the sharp, critical eye of a top-tier statutory auditor hunting for the truth hidden in the numbers. Until next time, keep digging deeper.